co-founder and CEO at Mumbai Angels Network. Warm welcome, ma'am. It's a pleasure having you here. And we also have Mr. Vikrant Vaishni, an experienced angel investor and partner at Succeed Innovation Fund. Warm welcome, sir. So ladies and gentlemen, we are all set to begin. I request everyone to mobile phones in silent mode, and I request everyone to please occupy the front row seats.
My name is Vikrant Vaishni. I run an early stage fund called Succeed Innovation, which is a deep tech centric fund, purely working at an incubators level. Large part of discovery happening with early stage tech incubators across India. And then we work with them progressively to do a downstream investment as much as possible. We are a small fund of 100 crore corpus, but I think in the scheme of things that's good enough for us to invest. If I'm not able to show up to everyone, I'll keep trying to moderate. But it's an interesting setup for us to have a conversation. I'll request each of the co-panelists with me to also do a quick 1-minute introduction about their fund, their fund's focus, and their definition of deep tech, so that when they're giving an answer, you understand their perspective as well. So,
yeah, hi, my name is Ashwin Raghuraman. I am a founding partner at a fund called the Bharat Innovation Fund. We invest in early stage deep tech startups that address global markets. We have a second fund vehicle which focuses on the inclusion side of things and focuses on how digital technologies can impact India markets, especially Tier 2 and Tier 3. And we have a portfolio now of about 18 companies managing a little bit less than $100 million in capital. Invest pre-series A to series B rounds. And yeah, that's a little bit about us. How do I qualify deep tech? Maybe just a quick one. I think I set up my first fund back in 2009. It was called the India Innovation Fund, perhaps India's first deep tech focused fund. And there was no phrase called deep tech then. So I used to struggle to even describe what we were looking to invest in. So I used to say, listen, startups that are creating IP and that sort of thing. But essentially, if I were to think about deep tech, I think about it as a product first approach where you are building cutting edge technology, where you differentiate from your other competitors, either existing or potential competitors who may come in later, because of the strength of your technology and the strength of the product. And very often, deep tech startups are addressing innovation spaces, so they're actually developing markets rather than addressing a market that exists. And that's probably the picture.
Thank you, Ashwin. I'm Nandini. I'm the co-founder and CEO of Mumbai Angels Network. So, some of you might have heard of Mumbai Angels. We are one of India's first angel investment networks. Now, if we and that was started in 2006. Now, today, when we look at our journey, so many years later, we now define ourselves as a private investment platform. So that's something that I want to talk about. That the whole perspective has changed in the market. We're no longer just talking about startups and angel investing and thinking of this as small check sizes that individuals are cutting, but it has more started becoming an asset class by itself. So what we look at is saying early stage venture, and that could be any check between 50 lakhs to 10 crores, and it could be across ranges of I actually think that these definitions of seed, pre-seed, they've all got middle. It's more a function of what the founder wants to define it as. But we want to be there in the first few rounds of investing. So that's who we are. In terms of what we've done till now, we have a portfolio of about 200 companies, and of which about 100 of them have seen exits, stroke next rounds. And while I don't like to talk about this as a number, because I think that actually skews the discussion in but if you wanted to look at this as an asset class, we see this asset class to be one of the highest return available for investors, which is somewhere around 35% that our portfolio shows. Now, to talk about deep tech, I think our definition, actually, if I look at my entire portfolio of 200, we just basically divided it into 3 segments. One is on saying, what is a company that has actually got tech as its main business? So like the way Ashwin was mentioning, it's saying, are you building products? Are you building stuff where your main business is building tech products? That is in my way, a loose way of defining deep tech. The second is on saying tech enablers, where we are saying, are there businesses that were otherwise doing other things, but now they understand that tech needs to be a necessary backbone. So that's what comes in. And then we have what is called non-tech, which is consumer and brands and stuff like that. So if you asked us to give you a number, I think about, say, 70% of our businesses will either fall into, what is, if you wanted to say deep tech and tech enabled, and about, say, 40% of our portfolio will be what is what will come in tech space.
Good. So she covered a lot of my question already. But I guess that's the benefit of working with experienced professional and the co-panelists. But I'll just continue one more dimension with you, Nanti. When you get an opportunity between a tech enablement versus a deep tech component, do you see them differently? Do you evaluate them differently?
Absolutely. I think, see, if I'm talking of tech enablement, I will definitely want a proof of concept that it has worked. So there needs to be revenue, there needs to be existing customers, there needs to be some traction on what is happening. I will be willing to look at deep tech, even if it's a zero. That's one way of looking at it. The other way, and I know again it's is valuations. So we would have different kind of valuation that we see coming out for what is deep tech and what is tech.
Any reason for you to have a different parameter of evaluation and valuation?
See, in our view, deep tech is actually a 0-1 game. So what will happen is that if I am investing in something which is a tech product, it could actually become a winner, or it could actually just die. Versus a tech enabler is actually a existing business model that is now using tech as a thing. So that is where the metrics of revenue, EBITDA, cash burn, those things will come in. Whereas in deep tech, we are just trying to focus on saying, is this something new that is getting in? Is it available in the market? Is it actually going to change the way, say, an industry works, or say, a set of consumers work? So if you actually, and the entire early stage venture investing is a risky thing. But deep tech actually fits right at the earliest stage of risk.
So I'll just continue on that point and give my first observation and then before I go to Ashwin again. So when we work with early stage incubators, our focus would be to identify those deep tech proposition, largely with tech incubators where we would be betting on their technology. They would be using a component of AI, machine learning, computer vision, blockchain, or any such technology which will make this solution. Are you saying something for me, sir?
Can you raise your voice a little bit, please, or can I use the volume of mic? Cannot hear.
Can you raise
Okay,
it?
sure. I'll try. So our focus would then be to work with those companies and discover at them, and this company was highlighting if they're doing something for the first time, or at least their solution will create that differentiation. One additional thing is those solutions generally progressively over a period of time would also get better when you start to use them. And which means over a period of time that company, if they're going for a downstream investment, or if there is a strategic investor who's coming to look at them, build versus buy decision generally will go in favor of buy, because even if you would be able to create that similar technology-based solution in future, that technology may not have gone through the same learning, and their data sets may not have been trained that the other company would have gone through over a 3-year period, right? So that solution always have much larger capability to be picked up as a part of build versus buy. So we have seen early stage investment in deep tech space have been creating much sooner exits for us and a decent price point at which the transactions have been happening. And I thought I'd share that when we created a fund called IIID Seed Fund, an early stage fund, we got 6 exits out of 10 investments within 2.5-3 years period, because most of those were going to that deep tech element. But I'll bring the same question, Ashwin, to you from your fund, if you would like to quote 1 or 2 examples similarly on how you have been assessing them differently. how you see deep tech component, or sometimes if you want to even demystify a component of what you would see and saying, no, this is not deep tech and I would not. So share your experience. It's a free flow question.
Yeah, those are the hardest, right? The free flow one, you don't know where to start and where to end. But so let me ramble on for the next 1.5 minutes and stop me if I do too much. So fundamentally, I mean, we believe from a tech angle there are two broad, let's say, buckets. It's the guys who are pushing the boundaries of technology so that the world sees new things, is able to do something that was never done before, is able to solve a complex problem that either didn't exist before or is getting created even as we speak. And a lot of the AI startups do that. A lot of biotech startups, we have a company in the cancer space which is developing a drug that does that. The Elon Musks of the world do that. Try to push the boundaries of what humans are doing, or solve problems which are extremely complex. I think during COVID, a ton of challenges were put to us which we had never encountered before, and a bunch of startups, apart from large companies, came to the fore with some solutions which perhaps they had not even thought about earlier, right? And so for us, that is deep tech. And then the second part of it is where you need technology. People have already pushed the boundaries, but you need to give access to another set of what we call the next 500 million or the next billion people who don't have access to the same things. I mean, take financial products, take healthcare products, take education products. And we are fortunate to be sitting in Hyderabad, Bangalore, Delhi, and so on. But if you start thinking about other parts of the country, very often there is the access is a problem, and access to quality products. And we think tech enablement helps some of these products to be distributed to the more remote places or to a different section of society, and that's how so the target market for both is very different. Deep tech would typically, even though we invest in a lot of B2B companies that adopt, even the best companies in India adopt at a slower pace. A lot of the international ones are what are looking at adopting deep tech companies or deep tech products. So that's the target market itself is very different. In terms of an evaluation, I think broadly we follow 3 vectors to evaluate any startup: product or technology, team, and the market and the opportunity. And these things change between a deep tech and a tech-enabled startup. In a deep tech startup, you would see the product vector being very strong, whereas in a tech-enabled startup, you'll see something else, you'll see more traction and so on. So, but the fundamental core of evaluating any startup to invest stays the same. I don't think deep tech, sometimes people say, it's very binary outcome with deep tech. I think with startups in the AI space, especially given we count that in deep tech, I think it's almost a way of life now that AI has become the next IT. So we see a lot of adoption there as the next step, right? But we look at, I think, technology far more closely when it comes to deep tech startups than we would with tech-enabled startups. We look at more of adoption with the enabled startups. And so we get into, do you have patents? Who is going to build it out? What is the quality of the team that is creating these deep tech startups? What have you already created? What else is there in the world? Not just in India, which competes with you and things like that when we think of deep tech.
Great, very good overview of what you would do and how you would look at. And by the way, this is first panel discussion where a coffee is walking to us, so I guess we're all enjoying the informal setup of interaction.
So I was waiting for 30 minutes for a coffee. I didn't realize once you come and sit here, I come and sat here longer.
I would like to point this question, Nandini, to you. You said in one of the responses that you would have different lens to evaluate. So on the tech enablement side, you would still be okay. You would look for traction, numbers, business shaping up. Whereas on the deep tech side, you're still more liberal. You're okay for gestation period to below. Just would you like to elaborate why and what's the thought process behind it, so that if there are founders sitting here, they understand your dimension.
See, I think you're looking for stuff that can maybe change the world, if I can want to put it like that. And we would want to get it early or something like that. Now, having said that, I want to put a caveat here that we increasingly are seeing, and I'm again going to use Web3. So I think we'll have to stay away from fads and actually look at real businesses being built. So when you say deep tech, we would keep evaluating, saying, okay, what are the newer things a certain founder is doing or a founder team. But we would stay away from somebody who's saying, oh, I just think this is a good idea, or this is the 20th same idea that we're seeing. And we are seeing this increasingly more and more in what people are defining themselves as Web3. So to go back to the question, we are looking for getting in early into technologies that might change how a certain, a certain canvas is completely being redrawn. That is why it
But
is.
are you taking more risk on that?
I think it is, what we do is risky. I also think that early stage venture investing is about investing in people. And I know all of us say it over and over again, but I can't emphasize on it enough. I can just put 2 more colors to what I mean when I say that, we risk on. So it's not just about your passion, etc. That I think is a given. But 2 other things. One is is there the right team that has the complementary skills? That's number 1. More importantly, do you have the tenacity to hold on as you build out? Because there will be places where it will not work, it will look like you're going to die. What we have seen is that only those companies and founders that stay on, irrespective, are the ones who survive to say, yes, we did it. So, absolutely. I don't know if I answered the question.
In fact, that's how we have been looking. So, as we were discussing, since many of our early stage discovery, as I've been emphasizing on coming from incubators, a lot of it comes from tech incubators. Those tech incubators would be having a lot of research back activities going on. That's where professors would be supporting. I at least can vouch for IIIT, Hyderabad, IT Madras, IT Delhi, Bombay, organizations which are known for creating a lot of this. We would be able to really work with them, trust them, understand their ability to differentiate. That's where we give them an early capital. We are also saying we're okay even if they're at a pre-MVP stage, as long as their thought process is running in the right direction. Many of these things are full of unknowns. As long as they're defining the vectors around which they're doing development and they're certain and clear on it, we'll take a plunge on it. And progressively as they make their product, that's where we'll do a follow-on round investment. Our fund is designed to be 20% at the time of discovery, but 80% in the follow-on rounds, right? This is where progressively we put in more capital in the companies which are doing good. And we have kept large part of the capital purely with the objective of growing companies, not having resource crunch at any point in time. And at least that has been working well for us. But I'll ask same question to Ashwin. Ashwin, you have been running, India funds, India Innovation Fund. I think now 3rd fund now. Second. Yeah. As your experience is evolving, in this deep tech space over last few years, and the fads which Web3s, Metaverse, are you getting into some of those and demystifying them also as a part of your investment thesis?
Yeah, first I just want to underline something Nandini said, right, because it's gold. Perseverance of the entrepreneur. People ask me what is that trait you look for in an entrepreneur. I think perseverance goes a long, long way. But she spoke enough about it, so I'll stop there. I think just to answer your question, it's not just our experiences that are evolving in the deep tech space. India as a startup nation has changed since I first started investing in 2009 to now, right? And what is changing? The quality of the entrepreneurs, the number of entrepreneurs, the quality of deep tech startups. We had very few. I mean, I'm coming from a time when people weren't, at least when I was first investing, when people weren't ready to marry off their daughters to startup founders, right? And today is just it's a fashionable thing to say, hey, I'm a startup founder, right? I mean, it's how things have changed. And if you think about it at that time, forget about deep tech, and people weren't talking deep tech, there were very few that we had to choose. Now there are so many startups. So the whole landscape of deep tech has changed. Our learning is that, and AI hit us somewhere in the middle, right? Maybe 2016 or 15, we saw the growth of the beginnings of a lot of AI startups. So that's obviously one area where I believe our startups have only scratched the surface. And we've had tremendous success with AI startups. be it in computer vision or other aspects of AI. To the specific question on Web 3.0, I think we are still watching. We're still watching even something as fundamental as blockchain. We believe that with something like AI, the way it's panned out is India is a very application, use case type of, our startups are very much not on the core infra, but on the application side, right? And so we have a lot of startups across multiple sectors in AI. I believe again when it comes to blockchain, are you solving a real problem in a real sector? And are you solving it differently because you have blockchain technology or because you're in Web 3.0, right? So some of these spaces we are still in watch mode, but we do think there are many, many spaces that still remain. Biotech is untouched. Space tech, which emerged, we have a few startups emerging over there. Material science, right? Somebody using material science, we just invested in a company which is using material science to be able to change or change the dynamics of something called an intraocular lens, which is put into your eye and solves for cataract, but now with material science they're trying to solve for cataract plus refractive index together. So there's just so many other areas, and unfortunately we tend to go with the buzzwords, which is the Web 3.0, and we as investors try to stay away from the fads, right? And try and identify areas where we think there will be strong signal and less noise. And for us, some of these areas still haven't shown us enough signal, but when it comes about, and we do think it will, we'll identify the specific niches within a broader area which shows strength. So for example, metaverse and training, the combination makes a lot of sense to us, and I think it will pick up. But metaverse and something else, we're still not sure, we're still watching. So that's how we're thinking.
So you're still picking it up with technology adoption using use cases and segments, which is how you were saying application centric?
Actually no, because if we look for adoption as our proxy, then we'll be too late. And we also want to go in early. So we have to think ahead as to what will get adopted at the point of time that we invest. I invested in a company called Entropic, and I know when they went out for their first fundraise, they used some brainwave mapping and AI for use case. I won't get into details. But they went and spoke to a couple of other investors. One said, hey, you're talking science fiction to us, right? And this was a well-known fund. So it's a little bit futuristic, which means you don't have the benefit as an investor of saying, adoption is happening. So chalo, let's fuel the next phase of growth. You have to predict adoption in a sense, and that's what makes it risky for us, but also fun, I guess, at the same time.
Is there also a color to it that some of the emerging technology which are still shaping up, you feel that from a ROI perspective they will take longer time or lesser time to develop? What does your initial thought process?
I think rapid. I think anything can generate returns, and the way we think about it is that capital always follows the highest return. So when we invest, we are also looking for follow-on investors to come in. It's like a relay race for us. So we have to be cognizant who else is going to eventually come and invest. And where there are real problems being solved, but at the same time where returns are generated is where capital will eventually flow. So we are also watching for that and investing in spaces where we think maybe capital is not going today, but larger rounds will start coming 2 years down the line, 3 years down the line when they need it. But I think it will be rapid. The good ones will scale up rapidly. The ones who are, this is the case anywhere, whether it's deep tech or otherwise, ones who are not good will be left by the wayside, ones who are good will scale up.
Sure. So before we wrap it up, I have one more question for Nandini, but I wanted to ask if you guys have any question, and if you're loud enough, you might have to just ask a question from your seat. Mic may not be able to reach you. Please.
I'm loud enough.
Are you?
Good afternoon. I'm Venkat Srinivas Reddy from Hyderabad. In deep tech, how do you value, because it's very nascent stage, so how do you value the startup? That is number one. And secondly, there are so many fintech companies coming up recently. They say there could be a bubble also. We don't know what will happen in future. These fintech companies, maybe the technology is advanced so much that it is easy for a new entrepreneur to start a fintech company with some funds and then take it forward. Do you think there could be some problems, like in the microfinance thing which happened in the previous decade? That's the second. Third one, ma'am, there is a short one. Recently, Mumbai Indians funded a hydroponic agriculture startup. Can you throw some light on that regarding valuation, etc.?
So I think you actually asked for a master class. So, see, the third one is an easy one. I don't think we can disclose the valuations, but for a hydroponic, it's easier for us to value because it is basically, there is some visibility on the growth stage that you. So, if they build a business plan, we'll know that maybe they are 15-20% here and there. So then it's easier, and then you're doing a multiple of revenue. When is it that they'll stop burning cash? How much more money will they need? So that's an easier one. Fintech on whether something is a bubble or not, I think we should do away with this mindset of saying that there are bubbles being created. Right? So I just want to, maybe spend 30 seconds on this, and I'm going to pass on to Ashwin to take the difficult part of the questions. So, see, I think we in India today are at the bottom of what is called the hockey stick. And for the next 10 to 15 years, we are all going to be in an upward spiral. My belief is that, if we are looking at us being a 10 trillion economy in several years, 5 trillion of that will be built by companies that are not even born. The question for all of us in this room is that are we either going to build that or invest in that, or are we going to stand on the side and say, this is a bubble, this is a downturn, things are going to. So I'm just going to leave it there and then.
First one was, how do you value the deep tech startups in the initial stage?
Okay, so the same three. Yeah, I think value. Sure. I think it's an art more than a science. Valuing deep tech startups. Valuing any startup at the early stages is less of a science. There's less mathematics behind it. There's more artistry behind it. It's an art. There are thumb rules that we follow. We look at like companies, so it's very experience driven, and therefore it's there's less science. We typically use a lot of multiples to value startups, and just to give you an example, a very common metric for SaaS deep tech startups is a multiple of their current or their ARR. And during last year, when there was a lot of money in the markets, US and India, you were seeing multiples between 20 and 30. Now that's corrected, even a little bit of a dip has now come between 10 and 15. So we also look around to see how valuations or multiples are flowing down from the public markets, which is where true price discovery takes place, because there's a very wide base to the private markets, which are later stage private equity funds, and then to early stage funds. But if you really ask me, how do you value a startup? I think a lot of it is a mix of that, a method there, a mix of gut feel, a mix of experience, and then hard negotiations, right? At the end of the day, how many people are looking to invest in a startup, or how many funds, very often determines, the price or demand supply paradigm. I also want to comment on the fintech piece, and we had a couple of fintechs which are actually getting acquired as we speak. And I think what's going to happen is, in India especially, the financial world has over the years become extremely regulated. And so while you have issues that you had in sectors that you spoke about, I think there's a bunch of fintechs that are coming up which may not build to scale. So they may not become unicorns, but they will build and get acquired, and there will be consolidation that will keep happening. As in any other sector, there's going to be a bunch of them that will die as well, because they're not able to, they'll raise early capital, but then they'll not be able to scale and raise the follow-on round, and they'll end up either getting acquired or they will die. And so you will see all these scenarios playing out in fintech, but I feel a little comfortable with the aspect of governance and regulation that has emerged over the last few years, specifically to feel that you may not have, let's say, the glitches that the microfinance world demonstrated a few years back.
So I guess I'll just supplement and then close the session. I've been given a hint from behind on the last point, where valuation and art may not serve the purpose in early stage, where the numbers are also not there, and where we are picking up companies at a pre-MVP stage of extremely early stage. That's the time when we start with convertible notes, right? Where we don't even agree a valuation, and we say we'll agree a valuation when next round of funding will happen. We agree a discount on that round. So there are sufficient mechanisms available in the early stage category to provide capital. The focus is give them capital when they need to create and bring something to market, right? Idea is to support them when nobody else is supporting. With that, I will thank both my co-panelists. This was quick 20-25 minute conversation. We kept it informal, we kept it easy, we kept it no jargon, so I hope you guys could cherish that. And we look forward to, I'm based in Hyderabad, if you guys are around, come have a coffee with me in IIIT office, and Bangalore and Bombay are sitting next to you also, so I guess Hyderabad is creating that opportunity for all of us to collaborate and grow this ecosystem. Thank you.
Thank you so much, sir. So ladies and gentlemen, we are all set.